The stock market is rising so fast that a lot of people are calling it the everything bubble, as if the entire stock market is turning into one giant bubble. Now imagine, in 2008, it wasn't the entire stock market that turned into a bubble, but just the housing market. But that crash alone took down not just the US economy, but the entire global economy. It led many countries into a crisis that they are suffering even until today. What happens when the everything bubble crashes? But on the other side, the stock market isn't showing any sign of a crackdown. It's not slowing down anytime soon. Yes, there are some small drops in the stock market, but overall, if you zoom out and look at the big picture, all you see is that the stock market is rising as if it's never going to collapse. Over the last 5 years alone, the stock market has increased by almost 100%. This is one of the fastest increases in the S&P 500. Usually, this is not normal for the S&P 500. And we are talking about the collection of companies. Within these companies, there are companies that failed. If you take individual stocks, then we have seen growth like we have never seen in the past. So the real question that a lot of people are wondering, why hasn't the market crashed yet? There is literally every single sign that the stock market is overvalued. And this is not like an exaggeration. If you understand the basic of finance, if you understand the basics of the market, it's not difficult for you to come to a conclusion that the market is insanely overvalued. It's not just people randomly throwing the word the everything bubble. Just look at the PE ratios of companies. Apple, the largest company, has a PE ratio of 37. That is insanely high. Usually, investors pay for every dollar that the companies are earning, that's what a PE ratio is, price to earnings ratio, of anything between to 20. If it's a technology company, we can be a bit more optimistic because tech companies can come up with new technologies and create extra sources of profits. So we can go as high as 20 to 25. But 37 PE ratio for a company that is worth $3.7 trillion is insane by any metric that you take. Nvidia, another company, has a PE ratio of 53. This is the most valuable company in the world, and instead of people selling off their shares because the company has crossed the $4 trillion valuation, they're like, we don't care. For every dollar that you make Nvidia, we are ready to pay a single dollar. That doesn't seem like a wise investment to make. Amazon has a PE ratio of 33. Compared to Nvidia, of course, it is way lower, but still, a 33 PE ratio is insanely high. And I haven't even talked to you about Tesla, where the PE ratio stands at 252. Tesla is no longer the little startup where you can pay a PE ratio of 252. Tesla is one of the largest tech companies in the world, and it's on the way to become a $10 trillion company. And I can't imagine when Tesla is going to make enough earnings to justify such valuation. It makes no sense whatsoever. The real question that everybody should be asking, or everybody is already asking, is that who is buying those stocks? Where that demand is coming? The only reason that the market is growing is because somebody out there is buying those stocks that is creating that demand that is leading to such high growth in stock prices. So if we answer this question, suddenly we can figure out why the market hasn't crashed yet. In 2025, companies have spent $1 trillion in stock buybacks. What is a stock buyback? Is when a company takes its profits and instead of doing something with it, like buying other companies, giving it in form of dividends to investors, or doing anything with that money, it is taking that cash and buying back its shares. Wait a second. Think about for a moment, what does that do to the share prices? We have a set number of shares in the market, let's say of Apple, and then we have people who are buying those stocks. If the company artificially takes billions of dollars and buys back its shares, it is creating artificial demand, which is leading stock prices to rise. And that is why stock prices are rising so fast. And In 2025 alone, this year, the year is not over yet, companies have spent $1 trillion. This is an incomprehensive number, spending so much money on buying back your stocks. Basically, when a company reports a revenue, it has to deduct expenses, and then it makes a profit. That profit must be taxed at the corporate tax level. And after paying taxes, the company is left with some money. And that money, instead of spending it on building more factories, on paying off more workers, the company is spending to buy back its shares. So, who are the kings of stock buybacks? It has always been Apple, at least in the last 10 years. This year, they have spent $100 billion buying back their stocks. Now you know who is buying so many Apple shares. At number 2, it's Alphabet that spent $70 billion buying back their stocks. Nvidia spent $60 billion buying back their stocks, and so on and so forth. You can see that companies are literally throwing tens of billions of dollars. So in total, they amounted to $1 trillion of stock buybacks just this year alone. And that number seems to rise every single year, creating that artificial demand. And this is not unique to 2025. In 2024, these companies have spent $942 billion buying back their stocks. So we have a bunch of companies who are making unbelievable amounts of money, the kind of money that nobody can imagine, and instead of giving that money to investors, they take that money, buy back their stocks. Then they make a lot more money. They make hundreds of billions of dollars. Take those money, buy back their stocks. In 2023, that number was slightly lower at $800 billion. But in 2022, they literally hit the record. They spent $1.1 trillion buying back their stocks. When the Federal Reserve hiked the interest rates in the beginning of 2022, the entire stock market almost collapsed. Literally, it fell down by about 20% or maybe even 25%. And logically, if you have made the math, the crash should have been much bigger because it has risen for no good reason back in 2020 and 2021 when the Federal Reserve pulled the trigger and moved out those cheap money out of the economy, the stock market should have plummeted. But because those companies took all of that cash, and most of that cash, by the way, was borrowed at a very low interest rate, they simply started buying back their stocks, reducing the number of shares in the market, while if the demand stays the same, the market does not crash us. But this hasn't always been the case. Companies weren't aggressively buying back their stocks all the time. If you go back 20 years ago, the total amount of stock buybacks was at $168 billion. If you compare it to today's $1.1 trillion or almost $1 trillion in 2024, you can realize that that number has grown by a substantial percentage point. So with each consecutive year, companies realized a loophole. We can grow our stock prices by buying back our stocks. Over the last 5 years, the price of Apple stock has risen by 100%. And that is all because the company has spent so much money on buybacks. So this is how we basically value companies. You have a company. Based on the amount of profits that the company is going to make, that is the true valuation of the business. So at the end of the day, because it's a publicly traded company, we can't just look at the overall profits that the company has made because it depends on the number of shareholders. So we take the final earnings, the final profits, and divide them by the number of outstanding shares. And that will give us earnings per share, or EPS. Now imagine for a moment if the revenue of the company or the profits of the company stayed the same, but we have reduced the number of shares in the market or the number of outstanding shares. Suddenly, earnings per share have increased artificially even if the profits of the company stayed the same. And on paper, that makes the company much more valuable. If the market is overvalued, why do companies spend so much money buying back their stocks? If we are in the AI bubble, if we are in the everything bubble, it makes no sense for these companies to buy back their stocks because the bubble is going to burst and these companies are going to make a loss. It does not make sense. Either these companies know something or we are not in an everything bubble and we should be investing right now? Well, you see, when you have a company that generates so much money, they have to do with that money something. You can't simply be sitting on a bunch of cash that you don't know what to do. And when the company reports profits, at the end of the day, it has to enrich the shareholders. One of the ways that companies do that is by paying dividends. Dividends is distributing profits to the shareholders who are the owners of this company. But when you distribute dividends to shareholders, these shareholders on the other side have to pay taxes. Do you think those rich people want to pay taxes? Well, of course not. So it makes sense for the company to buy back its shares, which rises the value of the stock. So even though that investors did not directly receive cash from the company, the valuations of their shares have become much more valuable, which benefited shareholders at the end of the day. And that's why shareholders don't mind these companies to spend so much on stock buybacks. But it also benefits the CEO. CEOs often are getting paid based on the stock compensations. So if the stock reaches a certain level, then the CEO gets a certain amount of stocks. And that's why the CEO of the company is much more interested in growing the stock price than paying dividends to shareholders. Another reason for that could be there might not be a better alternative to spend that money. So if you have a lot of money, you are going to invest it. Maybe buy another company, build another factory. But if you don't see a good investments in the market, what are you going to do with that money? Well, the best investment leaves at the end of the day is just to invest in yourself and just return that money to shareholders in form of buying back your stocks, because that allows them to bypass taxes. And finally, the fundamental reason could be that they're expecting high inflation, and that's why it makes no sense to sit on so much cash. If you expect the inflation to be 10 or 15% in the foreseeable future because of the amount of money that the US government is printing, and by the way, it's not just the US government. If you take any modern economy, any Western country, from the United States to the United Kingdom to every European country, you see massive borrowing, massive printing of money. So if those companies are expecting massive inflation, why should we keep hundreds of billions of dollars of cash? We are simply going to buy back our stocks. The official inflation rate is 3% in the US, but the real inflation is 10%. Because when you look at the CPI data, that CPI data is collected based on a particular number of goods that the CPI collectors usually rely on. It does not reflect the overall inflation. For example, it does not include house prices. It does not include rent prices. So the inflation rate could be 3%, but when you look at your real life, you see that the cost of living has risen by 7, 8, 10, or maybe even in some cases 15%. So these companies are not fools. They understand that the real inflation is much higher than the CPI reported inflation, and that's why they would rather buy back their stocks. And this is why the stock market hasn't crashed yet. And rich people don't mind, because as long as the value of their stocks in the market is growing, they can borrow money against those stocks. They will go to the bank and they will say, listen, I have like $100 million worth of Apple stocks and I need cash. So they will put those stocks as a collateral in JP Morgan or Citibank or whatever bank, and they will simply borrow money and they will buy whatever they want. They can fund their lifestyle. And that's why the only way to win in this economy is to make sure that you are an investor. Investors are the only people who are winning in this economy. The CEOs, the people who work on those companies, they never receive real cash. They rarely accept a salary. They mostly rely on stock compensations because the value of those stocks are growing tremendously. So if you want to win in this economy, the only path that you have or anybody has in this economy is to ensure that you are invested in the right assets. So if you want to know what are the top 5 stocks that you should be buying right now, check out the first link in the description of this video. Thanks for watching, and I will see you in the next one.